The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A drop in yields gives stocks room to run, but run to where? That is the question. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick. We're kicking you off to the close here on this Monday afternoon with stocks higher into this first trading day of the month, with traders fresh off of that turbulent July, a July, of course, that still ended with back-to-back gains for the S&P. Throw in today, and you got a three-day run here with the S&P now back above all of its key moving averages. No coincidence there that meaningful drop that we are seeing in oil prices having a big impact here. Remember, it was a 5% drop on a weekly basis last week. You add 5% here on the daily basis here, and you get a big sense here of why you see green at the top of your screen there. Keep an eye on yields as we are seeing a bit of a tamp down here on this Monday afternoon after last week's 15 basis point jump that we saw. And I do want to take a little bit of a closer look at those yields because that U.S.-led currency intervention to contain the drop in the yen, that actually kept Japan from being a forced seller of U.S. Treasuries, and that's a big part of the reason why yields are actually down, prices up. But the Treasuries rally, some of those gains are actually at risk of fading just as quickly as they came. Remember, Warsh's warblings on inflation and the perceived lack of transparency last week still has some bond investors a bit shell-shocked. They're demanding not just more answers, but more of a premium to buy long-dated Treasuries.
You can't fool the bond. You can't do it. The bond will see through it, and that is our interpretation of what happened last week. And if this continues, the bond will continue to reflect a greater inflation risk premia and more uncertainty. And the only one who's going to be crying will be the taxpayer, because it means higher associated costs and likely wider bid-offer spreads.
Treasuries also have to reckon with macro conditions that do suggest higher yields may be warranted. The ISM's measure of U.S. factory activity surging last month to the highest since 2022, a measure of employment in that space. We saw manufacturers increase headcount for the first time since 2023. The ISM releases its services gauge on Wednesday, which should provide a bit more insight. And that's, of course, going to be followed by a slew of labor market data leading up to Friday's monthly jobs report that is expected to show a rebound in the number of non-farm payrolls added. And, of course, don't forget earnings. 138 S&P companies on tap for this week, including Palantir, AMD, SanDisk, and SpaceX. In fact, Deutsche Bank strategists say the tech earnings report from last week and the slate up ahead this week that will spur a meaningful rotation back into tech stocks as a lot of the froth in the equity market has been removed. Valuations have actually been reset, and a lot of that prime brokerage data, it actually shows leverage has largely been cleaned up. Let's take a closer look at those valuations, though. Take the S&P as a proxy here on a relative basis compared to what you're seeing overseas. You're actually seeing valuation drop back down to some of the lowest levels that we've seen since 2020, 6 years. You throw the NASDAQ 100 onto that same chart, and it is a similar story. And on a single stock basis, some of the valuation reset is even a bit more extreme. Joining us right now to kick us off to the close here on this Monday afternoon is Mona Mahajan, Head of Investment Strategy over at Edward Jones. Mona, great to see you here.
Great to be here.
Let's talk about this valuation reset, because on one hand, I would think this was probably a favorable situation for a lot of investors who do believe in the long-term nature of the tech trade. You had earnings. Yep. The earnings are there. Price, at least heading into these earnings, for a lot of these names, were down. Yep. So what's the mix right now?
Yeah, absolutely. Look, it was fascinating to see. We know S&P returns are driven by two factors, valuation expansion and earnings growth. We didn't have valuation expansion across really any sector this year. In fact, a lot of valuation moderation. Earnings growth has been the story. And in fact, coming into this quarter, we all thought 20-25% earnings growth. We're looking at 35 to 40% earnings growth for Q2 thus far, and that has largely been driven by tech. Now, of course, to your point, tech came into the quarter actually in a not bad setup. We did see the semis kind of take a little bit of a breather. We saw the correction after a parabolic move higher. And the Mag 7, by the way, hadn't really been participating all year. So this slew of earnings that showed us not only CapEx spending increasing, earnings backlog and revenue backlog increasing, but meaningful revenue potential for the Mag 7 and hyperscalers ahead.
I am curious about the rest of this earnings season, basically the non-tech side of the earnings. And we got some non-tech. Obviously, the banks did well. We've seen some healthcare companies do well. But we're going to start to get a lot of the consumer companies, the discretionary names as well. Is this sort of broadening of the earnings picture that a lot of people were hoping for this quarter? Is that going to materialize?
You know, it looks like thus far earnings growth has been strong across tech and non-tech parts of the market. Certainly what we saw heading into earnings season, we did see broadening of market leadership. And in fact, a lot of the leadership beyond the S&P 500 came from areas like small and mid-cap stocks. Obviously, the EM sector played a big catch-up as well. But we also saw value dividend parts of the market, cyclical parts of the market, play some meaningful catch-up. And we think that trade does have legs. We know as we think about the next leg of the AI trade, it's going to go from AI infrastructure to AI adoption, which we think is still an early phase, and that's where you want to be positioned.
So with regards to the AI adoption, are those AI companies or tech companies, or are we talking about more like the healthcare names and the banks and those types of companies that are benefiting from internal use of AI?
I think it's the latter. You know, I think the next phase of this AI trade, which is in very early stages, is going to be in the sectors that could actually see some productivity gains. We haven't quite seen it yet, but areas like financial services, to your point, healthcare, industrials, maybe the manufacturing side, all could see some meaningful productivity gains in, we think, the quarters ahead. That's where we want to start angling portfolios, making sure that we have exposure there.
I do have to ask you about some of the macro issues, and let's just kind of go back to last week and Kevin Warsh and the Fed. Obviously, a bond market that I think still a little bit on edge as to exactly what comes next. I mean, is there a sense here, at least when we look at the link between what's happening in the Treasury space and what may or may not be happening in the equity space? Are we at risk of the equity rally being upset by some of the issues going on with treasuries?
Yeah, you know, it was certainly a mixed message last week. And in fact, I think the market really punished Chair Warsh for talking tough but not executing. So we, of course, got a hold last week. Fed funds rate still at 3.5 to 3.75%. We do think, though, that the picture coming into that Fed meeting looked a little bit mixed as well. You know, we did get 2 softer inflation readings prior to that. Now we have oil prices that have rolled over a bit. I think the next 2 CPI prints will be critical. We'll get 2 before the next meeting on September 16th. And I think that's where, if the Fed and the FOMC is going to take a stance, that September meeting in our mind is very much a live one.
A live one. Is there any risk, though, that inflation becomes an issue for corporate profitability? Because, I mean, we talk about it around the edges. And so far, I mean, not to, minimize it, but so far, we haven't really seen it show up in a material way.
Yeah, and it's a fair point. And, even with treasuries close to the highs of the year, the 10-year hit 4.7% and higher, we have not seen a slowdown in CapEx spending, in borrowing. The consumer has very much held in there. This is an economy that has been able to not only survive, but thrive somewhat, even in this elevated yield environment. So in our mind, even if the Fed does execute a 25 basis point rate hike, maybe it gets 1 or 2 rate hikes in this cycle, doesn't necessarily derail the broader economy and the broader story. What we are watching, though, is do inflation expectations remain anchored? And thus far, when you look at a TIPS market, when you look at some of the Fed's own forward-looking inflation metrics, inflation has remained anchored. And that, to us, is a good signal thus far.
All right, Mona, got to leave it there. Always appreciate it.
Great to see you.
Absolutely. Mona Mahajan, Head of Investment Strategy at Edward Jones, kicking us off to the close here on this Monday afternoon. When we come back, we talk private credit and a platinum era, at least according to Churchill Vice Chairman Randy Schwimmer. We're going to talk about where he sees opportunity coming up next. And from private markets to, well, now the public market. SpaceX preparing for its first earnings report as a public company. We're going to break down what to expect with Zhu over at MoffettNathanson a little bit later in the program. And more green for stablecoin infrastructure company Yellow Card. We're going to catch up with CEO Maurice, fresh off his latest funding round, to talk about what's next for the Visa-backed operator. All that and more coming up in a bit, right here on The Close, right here on Bloomberg. All right, let's talk healthcare, and particularly the research behind it. The Trump administration is accelerating its plan to overhaul medical research in the U.S. A report released by the White House outlines $200 billion in spending per year to support individual scientists and private research facilities. This is in place of some of the money that would have gone to universities that rely on federal funding for their research. Joining us now is John Flavin. He's the CEO of Portal Innovations, which helps fund early-stage medical research funds. It's based out there in Chicago. It seeds, it builds, it scales all of these early-stage life sciences companies. And when I hear about this new initiative by the Trump administration, I think, isn't this your business model, John? You've been kind of banging this drum for a while, that the private sector can do a lot on its own without the traditional university-led research capacities.
No question about it. I mean, let's not understate how important the university infrastructure is to American ingenuity and innovation. Having said that, over the past several decades, funding from the federal government has continued to be moving downward, and as a result, that has enabled more of a motion of focus on translational research, meaning taking great ideas that professors develop after years of studying and understanding how a new molecule might help fight cancer or Alzheimer's. How does that get translated into a product and a drug that could treat patients down the road? And with the administration pulling back to a certain degree on NIH and NSF funding, or at least not being overtly supportive at the greatest scale that we've seen in the past several decades, that has opened up the door then for outside groups to start taking greater interest, whether it's foundations, venture capital firms, angel investors, to start translating research coming out of the universities at a greater pace. And I do think the movement, or at least the aspirational elements that are outlined in that plan by the Office of Science and Technology Policy are encouraging. I think if you look at the need to revamp the way we think about funding basic research, now is a good time to be doing that.
I do have to ask you, though, and you do kind of give a hat tip to the importance of universities in our scientific endeavors. But you've talked about in the past on this program the idea that companies like yourselves and others have an incentive to sort of be much more involved much earlier in the research and discovery process. Have we already started to see that even prior to this initiative by the Trump administration?
No question about it. The rise of foundations, for example, patient advocacy groups that are starting to, use their own financial capital, partner with pharmaceutical-like organizations that can take ideas out of universities and treat, for example, rare diseases. We have a number of examples of companies that we support that, are focused on, very rare diseases that need access to different kinds of funding sources that are not available through the federal government and are not available necessarily through late-stage venture capital groups.
Yeah.
And yet, at the same time, a lot of those innovations really are important for these patients that currently don't have, any capability of being able to alleviate that disease.
I am curious, though, John. I mean, a lot of what you do is a focus on life sciences. And I was going through the report, and there is an explicit sort of focus on what I guess they're referring to as physical science over bio, if you will, to a certain extent. Is there a conflict here in terms of what they're pushing, in terms of the types of research they want and the types of things that you and your peers are already doing?
My understanding is, they're going to allocate an outsized amount of capital, up to about $5 billion, toward AI. And again, as a country, this is an area that we know we need to deploy a lot of capital and free scientists to be able to work judiciously to stay at the cutting edge from the global competitive race perspective. And so I think that's a good thing. And I think the underpinnings of that, too, have implications in healthcare. Of course, AI can be applied to a lot of different applications. And one of the areas that's ripe for that is healthcare, new drug discovery, development, clinical trials. The U.S. has to become a lot more aggressive at going more quickly from idea at the bench into humans and being able to, get through FDA approval much more quickly. That's one of the other provisions noted in the memo was, the ability to start to streamline FDA review processes, some of which we've begun to see get rolled out, meaning the movement for one well-controlled study versus two, which is previously what was required for FDA approval.
One criticism, though, of this report is the idea of whether the private industry will have the same long-term view that has led to some breakthrough discoveries. It's one thing to sort of look and say, okay, if we can do this in 5 years, we'll do it. But when you start to think about, GLP-1s and how long it took for that to come about, CRISPR, how long that took to come about, Higgs boson, how long that took to come about, are private companies going to have the same incentive to stick this out for potentially decades in a way that a university probably would not mind?
I think it's a very fair point that you're making. And again, we need to make sure that we're being very careful, as a country, to continue to invest into basic research that does take years, to get to the point where CRISPR becomes an actual application. Coincidentally, Jennifer Doudna's company, Scribe Therapeutics, just went public last week with a product with CRISPR, going into the clinic here in the near term. So right before our eyes, we see how important that early stage research investment is. The point, though, is more innovative money is coming from other sources. So, for example, we just opened our new lab at the New Jersey Innovation Hub in New Brunswick, New Jersey. Public-private partnership, state of New Jersey is getting very aggressive at investing in companies through funds and platforms like ours. And if you're going to do the kind of long, focused research, you need to start with the market in mind. So it's, to me, Romaine, it's a swinging of the pendulum to become a little bit more balanced. Yes, you need basic research, but you also need a market eye toward, am I solving a problem? So historically, back to Vannevar Bush, post-World War II, NIH funding, it was discovery on out. And I think what we're seeing now is the pendulum is switching, where it's market demand on into that discovery.
All right, John, got to leave it there. Always great to talk to you. John Flavin there, CEO over at Portal Innovations. And we're going to stay in the healthcare space when we come back, because there's a big deal brewing out there between Bristol-Myers and AstraZeneca. And, well, let's just say some investors don't like this deal at all. We're going to break it down for you when we come back after the break, right here on Bloomberg. Shares of AstraZeneca down as much as 10% as investors balking at the idea of a mega deal with fellow cancer drug maker Bristol-Myers Squibb. Now, according to people familiar with the matter that Bloomberg's reporters have spoken to, the two companies have held early-stage talks that could result in what would be the largest pharma deal in history. We should point out neither company has commented yet as to whether this would actually come to fruition, but of course that's not stopping anybody from parsing exactly how they feel about it. Joining us right now is Jared Holz. He's healthcare equity strategist over at Mizuho Securities. And Jared, let's get right to this. I mean, the share price reaction for AstraZeneca was pretty severe. We saw the shares in London down 9%. I think the ADRs here in the U.S. also down about 6% or so as we speak. It seems like this is just a simple I guess, the duality of it all. The idea that AstraZeneca is a company that is growing, revenue growth, EPS growth, et cetera, a big pipeline of drugs. Meanwhile, Bristol-Myers seems to be going in the opposite direction. What does AstraZeneca get out of this at all?
Yes, thanks for having me. I think it's pretty simple on the AZN side as far as the reaction. A little bit of a shock with how much money this deal would be in theory, and also why mess it up at this point. What they would get would be a large-scale pharmaceutical company, diversified, with a great deal of cost-cutting opportunity. I think that's really what it comes down to: is are there enough costs to cut where the degradation of some of the key drugs out of Bristol become less meaningful, and then the totality of the company over the next 5 to 10 years looks pretty good.
When we talk about the totality of this, just talk to me a little bit about the pipeline. I know what's in AstraZeneca's pipeline. For BMY, I mean, there are a few things there, but I was trying to look ahead, and it does seem like there are a few things that could have some potential, particularly around inflammatory diseases and obviously in the traditional oncology space. Is there something there that you're eyeing that maybe could actually really be additive to a combined company, should this actually happen?
Yeah, I think there are basically three pipeline opportunities or three segments that are worth watching. One is obviously oncology. This is where Bristol has a stronghold and very good positioning. Obviously, they're going to be facing some headwinds in time with Opdivo, and then you've got neuroscience and I&I or inflammation would be the third. I think all these three categories are really important to look out for Bristol. Potentially that's why AZN has some interest. They're bullish here, but other investors would argue and push back and say that why wouldn't they wait for some of these pipeline opportunities to play out rather than spending the money now?
Well, let's talk about a key word you just used there, wait. And I am curious just about the regulatory issues here. We're talking about what would be, if last time I checked, the largest healthcare deal, certainly in the U.S., if this were to be pulled off. Is this kind of the bankers pushing this, saying that, look, if you go down to Washington right now, you can get a lot rubber stamped if you know the right people. If you're going to do this, now's the time to do this? Is that maybe part of why we're seeing this?
I think so. I don't know how heavily it's being pushed, but I think there are probably bankers around who are looking at this administration and articulating a view of if you had any inkling or inclination towards a large-scale mega merger like this, now would be the window. And I kind of think that makes sense. If this window is actually closing at the end of this administration or not, it does seem like the opportunity is in front of them in a way that it has not been for a while.
And just real quickly here, I am curious just about whether there would be any issues with this particular administration, given their focus on trying to lower drug costs. Would that actually maybe upend sort of any benefit from this?
It's a good question. It's hard to know. I think one of the variables here could be AstraZeneca growing its presence in the U.S., which would be a positive. I would doubt there would be any articulation of increasing drug prices as a core strategy here, just to sort of get out of harm's way. So I don't think so, but over the long term, you just don't know.
All right, Jared, really appreciate you taking time for us. Jared Holz there, healthcare equity strategist over at Mizuho Securities. AZN shares and ADRs down on the day. Meanwhile, we're taking a look at shares of Yum Brands, down about 3% right now, as we're starting to learn some more details about the Cyclospora outbreak and exactly what these companies knew. According to a story that just recently crossed the wire, Michigan health authorities had already been in touch with Yum Brands, the parent company of Taco Bell, as early as July about this parasitic outbreak. Yum Brands now out with a statement just over the last few minutes saying that it did, quote, move swiftly to remove tainted ingredients, and that it did discuss its response in Michigan with regard to that investigation. We're going to try to get you some more details on this, as, of course, the shares remain under pressure on the back of that outbreak. When we come back, we're going to talk private credit. In the penalty box, or maybe not. Randy Schwimmer is going to be joining us, Vice Chairman and Chief Investment Strategist at Churchill Asset Management, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic. We keep our eyes on public markets as we count you down to those closing bells, but take a little bit of a moment here to talk about what's been going on in private markets. Just last week, we learned that the default rate across 1,300 U.S. private debt borrowers tracked by Fitch Ratings rose to a record high of 6%. That's for the second quarter. But our next guest says things are actually improving for the second half as the platinum era for private markets dawns. Joining us right now to discuss is Randy Schwimmer, Vice Chairman and Chief Investment Strategist at Churchill Asset Management, which he helped co-found nearly 20 years ago. Great to see you.
It's great to be back.
Let's talk about this disparity. We've had you on in the past, and you talk about this idea, particularly for the assets, for the lending that you guys do over at Churchill, that you're not seeing the same stress. You're not seeing the same defaults as maybe what we're seeing in the broader market. So kind of square the circle with sort of that 6% number that Fitch put out across those 1,300 issues. And what's under the hood at Churchill Asset Management?
So it's a great question, and a timely question. So I think I mentioned last month when we were here that the lead, which is coming out as a rebrand, we're actually going to be doing a webinar on defaults, and we're going to have the top 4 rating agencies in the middle of September, each talking about what they're seeing, including Fitch.
Okay.
And so what you discover is everybody's methodology is different. So Fitch, as an example, includes other things other than actual default rates. So for example, when they see a restructuring, or they see pushing a maturity, or they see a PIK loan, for example, they'll include that as if it's a default. And it's a reasonable assumption because the lenders are doing something to change the dynamics from the original deal, but it actually hasn't defaulted yet. So they'll explain this methodology and say, look, we think it's a risk, and we see the risk is a little higher, and hence the 6% that they have is a lot higher than some of the others. So we want them to come on and explain that. Now, what we're seeing in our portfolio,
but that's not just semantics. So I mean, that is a technical default if the terms change. It doesn't necessarily mean it's a washout. It just something changed, and I guess they have an obligation to flag that as a default or whatever in the market.
But then some of the other agencies don't look at it that way because they're actually saying, is the company in default of its payment, or are the lenders taking a look and saying, you know what, we're going to restructure this to allow the business to recover. And in some cases, it helps them recover, and then everybody gets their money paid back. But it's important to understand the differences. Like, why is one saying 6% and one saying 2%? So that's important. And in our portfolio, we're not seeing that because these are core middle market companies, as we talked about before. And we're seeing kind of the same level of risk that we've been seeing for the last 24, 36 months. Now, interest rates have come down in the last couple of years, so that's helpful. But look, interest rates are going to start to come up again. And so I think all investors are thinking now is, what is in this portfolio such that if interest rates go up, there may be more risk?
So when you say interest rates go up, is the expectations that they'll go up significantly, or we're just going to, bounce around? I mean, wherever the benchmark 10-year is right now, we're just going to bounce around that level, 4.5%, 5% or so?
If you think about the Fed now kind of saying that we're going to have at least 1 or 2 raises, hikes between now and the end of the year. So if you're thinking about a 9% unlevered yield on senior credit right now, you're talking kind of 9.5% to 10% by the end of the year. All right, so investors are looking at that and saying, well, that's attractive. Now, it's not the 12% that we had in the golden age of private credit, but I think this is a little more sustainable.
Talk to me about the difference between what we're seeing on the tech side of lending, with the particularly AI data center stuff, and the non-AI data center tech stuff. Is there a significant difference in how those things are being valued, where the multiples are, et cetera?
Well, right now it's interesting because the non-tech is getting valued a lot higher, because since the focus on AI in portfolios is so high, when private equity investors are looking at businesses right now, the old economy, ground level businesses that we kind of traffic in are getting almost as high purchase price multiples as some of the tech businesses. And I think tech is evolving. That's one of the beauties of it. It evolves all the time. And one of the things in senior credit, which is lower risk, is that we're not looking at high growth businesses. We're looking at steady growth businesses. And I think that difference that you mentioned between AI and regular way tech is something that's going to be evolving over time. And we're looking at it as with any other sector. We want to make sure that obsolescence risk is kind of our prime focus.
Well, when obsolescence risk, I mean, the idea is, okay, Halo, right? What are we talking like? Pest control.
Right.
HVAC. On and on here.
Vet centers.
Vet centers, yes. As somebody who has a dog, I could tell you, you guys get a lot of money out of me one way or the other. Just made an appointment over the weekend. But is there a sense here, you don't worry about, that's economic sort of, not necessarily proof, but economically resilient as well?
Yeah, that's what we discovered over 20 years, is that these businesses that are lower level, ground level, old economy, service-related businesses tend to be more resilient. For example, they tend not to be impacted by tariffs. They're less impacted by some of the technology, AI, for example. Pest control is not typically involved with that. And so, and there are 200,000 to 300,000 companies, middle market companies in the United States. 2/3 of them are kind of in the service sector. And so private equity firms that only own about 5% of the total have so much white space right now to look at. And they're looking at these businesses and saying, over time, tariffs and AI and COVID and all these macros that have roiled the upper markets are not affecting these smaller companies.
I do want to get your thoughts just about how the industry is changing, more from the perspective of the investor side. And maybe I'm making too much of this, but you had this newsletter product called Lead Left.
Correct.
You dropped the left.
Yeah.
Is there a reason for that? I mean, lead left has a very specific connotation in the world of finance.
Yes.
Is that sort of a nod to something, or is that just you just decided?
That specific reference is something that you and I would probably know about, but others might not, particularly the generation that doesn't understand about what old tombstones were in the Wall Street Journal, for example, right? Yeah. And the lead left was the lead underwriter on the top left of the tombstone ad that signified they were running the deal. Yeah. You don't see that in the journal anymore, and so we just thought that the reference was confusing. Mm-hmm. There are some of my personal contacts that would get this and think it was a political reference, which it's not. It's an investment banking term. But as we broaden the scope of the lead, which I think is an even more simple and powerful title, going out to now our Nuveen clients in the wealth channel as well as institutional, what we're trying to do is to sort of broaden the understanding of the asset class, because private credit right now has shown so much staying power. And the thing that's so attractive to institutional investors, as you know, over the last decade and a half, is equally attractive to the wealth investors, but they don't understand it as well because they don't have the experience that the institutional market has had. So with the lead coming out, what we're trying to do is to explain the asset class in a way that the average investor looks at it and says, okay, I understand, it's kind of like my house. I'm comfortable with the value of my house. I know it's not going to trade every day. Mm-hmm. Same with private credit. It's stable. It's going to provide me with income that is a higher yield than public credit. Mm-hmm. And it's going to allow me to not worry as much about these macro issues that we've been talking about, because these businesses are a little more insulated, a little more resilient.
All right, Randy, I have to leave it there. Great to have you back here on the program. Randy Schwimmer, Vice Chairman, Chief Investment Strategist over at Churchill Asset Management, and of course, the lead of the lead. Coming up here, we're going to talk eBay, selling off on a downgrade. Out of Wells Fargo, the analyst behind that call. He joins us next, right here on The Close on Bloomberg. Time now for our stock of the hour. It's eBay. The share is down about 6% here on the day, having its worst day going back to early February. This after Wells Fargo cut the stock to underweight, lowering its price target to 92, citing an increasingly competitive landscape in the U.S., along with increased marketing spend for one of its competitors. Joining us right now is the analyst behind that call, Ken Gawrelski over at Wells Fargo. Ken, all right, let's talk to me about the competition here, because for a while, eBay was kind of the place you went to, whether you were doing collectibles, car parts, watches, whatever. Now it seems like there's a proliferation of websites out there where I can get a lot of the same things. Is this a real existential threat to this company?
Yeah, well, first, thanks for having me on. I want to be clear that eBay has done a great job of kind of turning this business from a marketplace that serves everyone and everything for every purpose to having some real distinct strengths in verticals. And that's why you've seen their growth accelerate. This was a, hovering around 0% grower for quite some period and has accelerated. And the stock has appreciated significantly, has been a great performer. What we see now is there's an emerging, this is a classic competitive intensity rising case where you have a European competitor, for privately held company, Vinted, that is entering the U.S., has entered the U.S. in a specific area, which is like consumer to consumer, call it gently worn, gently used, fashion and accessories, entering into the U.S. What we see now is eBay, through this new asset they've just recently acquired from Etsy, Depop, they are aggressively spending to defend their market position and to extend their market position in the U.S.
Explain to me, though, what Depop does, because I hear this from my teenage son. Talks about it all the time, all of his friends. I would think this would be accretive. So is the idea that just the integration of it is going to be costly? Is that just a short-term issue, that long-term it smooths out?
So this is absolutely a secular growth area, and yes, against a younger demo than, dare I say, you or me.
Yeah, no problem.
But I'd say this. So we do think this will be growth accretive. That being said, this business is unprofitable, and what we've seen is a material increase in marketing intensity as this new entrant came in. So we do believe that this business has a lower return profile than the core eBay business. It's not that this is a bad move strategically for eBay, because there is a historical precedent where eBay had to reduce its fees or reduce its commission structure in both Germany and the UK over the last 3 years. And so it was very harmful to them from a financial perspective. Yeah. This is another way to fight a new entrant with this Depop asset. It is a secular growth area, but it'll cause some pain in the short term.
Just real quickly, only about a minute left, Ken. I mean, part of eBay's sort of secret sauce for a lot of people was the idea of trust, that there was this idea that you knew you were dealing with authorized sellers or mainly getting products that were what they were supposed to be. Does that not give them leverage over some of their competitors?
Well, it certainly has in areas like collectibles where authenticity, collectibles, higher end luxury items, et cetera. This is a little different business, right? This is consumer to consumer. This is an average selling price of around $20, much lower than the typical eBay product. So it has a little bit different flavor here. Yeah. And as such, I think it's a little different. Yeah. It also has a very different demographic, much younger. Yeah. And at that price point, I think there's a different expectation.
All right, Ken, got to leave it there. Ken Gawrelski over at Wells Fargo. We're just about 10 minutes away from the closing bells. Green across the screen with the S&P and NASDAQ up for a third straight day. The S&P now well above all of its key moving averages. That bit of a scare that we had over the last few weeks with that huge sell-off in momentum, giving way just a little bit now that the earnings dust has largely cleared for most of the big tech names. We do get some earnings after the bell tonight, including from Palantir and from On Semi that could shape the narrative, as well as from AMD and SpaceX tomorrow after the bell, something to keep an eye on. But at least for right now, a lot of folks coming back into the pool. The S&P up 1.5%, the NASDAQ composite up about 2.2%, and Dow Transport's adding about 0.7%. Some of this, of course, being aided by the drop that we're seeing today in oil prices and the drop that we're seeing in Treasury yields. Mandy joins us right now, Vice President and Head of Derivatives Market Intelligence at Cboe Global Markets. Mandy, great to see you here.
Great to be back.
Let's talk yields. Down today. Yep. We saw the big spike on Wednesday after the Fed meeting and a little bit more steepening that we saw on Friday. There seems to be this consensus, no matter what's happening on the day, that most people are betting on higher yields going forward. We just heard from Randy Schwimmer just a little bit ahead of you. He also says he expects yields to be higher as well. Are you seeing that play out right now?
I would say that certainly is the consensus when you look at the option market and what investors are pricing when it comes to the options market. So last week, post-Fed meeting, we saw not only a big jump in yield, but actually a big spike in interest rate volatility. If you look at our VIX TLT index, which measures the expected volatility of TLT, that took a big surge, big upward move. And then in addition, what we're seeing kind of in terms of the positioning is a huge increase in demand for puts. So if we look at TLT skew, which measures the demand for puts relative to calls, that actually hit its highest level since the global financial crisis, meaning more and more investors paying up for protection against a further bond sell-off, meaning positioning for yields to potentially move even higher. And I think that's a sign of increasing questions, I think, around credibility of the Fed and their commitment to fighting inflation.
Did that sort of arise on Wednesday, or was this already sort of in the works even prior to the Fed meeting?
This was really post-Fed meeting. Wow. Very abrupt move, abrupt repricing in the bond market in TLT volatility and TLT option market positioning post the Fed meeting last week.
It seems that for a lot of bond investors, part of the issue wasn't so much, they're scared of yields. It was this idea of that the lack of transparency or the perceived lack of transparency, something that Warsh himself even talks about, the idea that he doesn't think he needs to communicate to the same extent. I guess the question then becomes, does that set us up for more bond volatility perpetually, or at least as long as Warsh is there and as long as he takes his tack of maybe saying less?
Seems like it. I think that's exactly why you're seeing the kind of this rush for protection and this repricing higher in volatility, or in the expected implied volatility in the bond market. It seems the way that Chair Warsh has gone about kind of communicating, he almost wants that volatility in the bond market with kind of the lack of guidance, the lack of forward guidance, and a lot of the communication that the Fed has been kind of known for. So I think that is a trade-off, right? And one of the things that we're watching is this elevated level of volatility in the bond market and how much of it spills over into other asset classes.
Well, let's talk about some of the other asset classes, particularly equities, and draw the link there. I mean, we know kind of the correlations between, rising yields and the potential impact that has on stocks. At the same time, it seems like what we're seeing in the equity market, at least for the moment, is a little bit disconnected from that.
It is. I would say for now, equity investors are largely kind of, I wouldn't say brushing off the concerns around the Fed credibility or the long-term kind of trajectory for interest rates, but rather the more immediate concern is around earnings, particularly with the AI trade, the hyperscalers, their capex projections, and that's why I think last week was such a critical week when it comes to equity market momentum, right? So we had, many of the hyperscalers reporting earnings beat expectation. Capex largely came in, I would say, within expectation, and that really kind of provided the momentum for the rebound that we saw in the market.
We had someone on the program last week in the midst of all these earnings, and he said something. He said, basically, in his view, the dispersion trade was kind of over. The idea that you're starting to go from what was purely a kind of a single stock pickers type of market, and now you're starting to see a lot more correlations. Are you seeing the same thing in your data?
So not yet, but certainly that is a topic of discussion. Is the question of how long can this dispersion, like highly dispersed, low correlation environment persist, right? And I would say right now we're still seeing a fair amount of realized dispersion in the market with the earnings move, right? Like stocks are getting, either rewarded or punished based on their fundamentals, right? Double-digit swings in either direction last week. So certainly I would say there's still plenty of idiosyncratic risk in the market. But the question is, when does it turn more macro systemic? And I would say kind of what we're seeing right now with the AI trade, with free cash flow for the hyperscalers going negative, meaning they're now more dependent on external funding. So you could get more systemic macro risk through the credit channel. We're also seeing more and more investors talking about kind of the circular financing that we're seeing within the AI trade. Certainly that raises a risk that, something that going wrong with it. One company has obviously broader implications. And the third factor, which also would have been in the news a lot, which is leverage, right? So leverage is another channel in which an idiosyncratic risk can turn more systemic or turn more macro. And I think the way that the market is currently set up, which is pricing purely for that idiosyncratic move and underpricing the macro risk, has more and more people looking at taking the other side of the trade. So going long correlation, long market-wide risk, and short dispersion.
Well, we still have a few more earnings, particularly in the tech space. It could be volatile. AMD on tomorrow, NVIDIA, a few weeks away from that. I'm not sure exactly what's going on with SpaceX, but give me a sense here, though, of how people sort of set up for these things. Is it still just basically this binary trade of like, okay, we're either gonna, all go to the moon or we're all going down to the basement?
So interestingly, when we look at kind of investor positioning, particularly for retail, I think last time I was on the show, we highlighted that retail was getting a lot more bullish on the hyperscalers going into earnings. When we look for the chip stocks, AMD in particular for this week, actually a theme from the retail side is actually more and more people selling options. So actually taking a view that the stock likely range bound, and obviously the range is quite wide given the historical volatility for the stock, but more and more people actually taking advantage of the current high levels of implied volatility in AMD and in these chip stocks to either generate income through call overwriting or put selling, taking the view that the stock is likely to be more range bound in the near term.
Implied one-day move on AMD, 8%. Implied one-day move on SpaceX, 13%. Sounds about right.
There's a lot already priced in, exactly.
Mandy, always great to have you here. Mandy Zhu is Vice President and Head of Derivatives Market Intelligence over at Cboe Global Markets, looking at that options activity and feeding back into the cash session into this market with the S&P 500 set to close out the day up about 1.5%, 2% gains for the NASDAQ as a lot of people getting back into some of those high momentum AI tech-related names. But as Mike Wilson over at Morgan Stanley pointed out, there is a quality factor that's also driving this as well, a quality factor tied directly to earnings and cash flow. We're going to break down all of today's earnings. We're going to break down all of today's equity market action. We're going to break down everything going on in the Treasury space with our global simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here, taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Senevic, they join us right now. Welcome to our audiences.
Nobody wanted to play with you on set. Aww.
I didn't know we could do a. I didn't know we could do a 3-box.
You can do a 3-box.
How you doing? Is it
Be
hard?
careful, Carol. We can do a 2-box too.
too.
Welcome to our audiences across all of our Bloomberg platforms, television and radio, and our partnership with YouTube. Green on the screen, Carol Massar, for a third straight day here. Remember that scare we had, a couple weeks ago?
Everything is awesome.
Everybody was jumping out of the pool. Looks like people are willing to wade back into the water.
It's amazing, right? As we try to kind of dissect what's going on between the U.S. war with Iran. That's kind of confusing. We'll see what we get in terms of economic data. Big jobs report on Friday. Everybody's still trying to figure out Fed chair. I always want to say Jay Powell. Sorry.
Well, you've
Kevin
said it for the last 8 years.
Kevin Warsh. Yeah, don't blame Jay
It's
Powell
like
for
amazing
this.
these things that just roll off.
What do you think Jay Powell's doing right now?
You can probably send him an IB on the terminal.
I tried that.
Well,
I don't know. It's really fascinating how quiet, right?
Yeah.
I give him a lot of props that he's letting the new Fed chair do his thing.
Well, I'm curious about this because, obviously a lot of people did not take well to his communication or lack thereof on Wednesday. We saw that visceral reaction in the bond market. Obviously, yields tamped down today, though that seems to be more tied to what happened with the yen intervention. But it gets to this idea that most people are still betting on yields to be higher than where they are today, higher than where they were even on Wednesday.
That's a good point. That's a good point.
Well, we get the closing bells here in New York. Thank you, Carol Massar, as we await a couple of earnings coming out, too, including from Palantir and on Semi. Green across the screen for all of the major indices here in the U.S. The Dow Jones Industrial Average adding about 700 points, or 1.3%. The S&P looks like it's going to close right at that 7,600 level, barring some huge tick in the next second or so. That's up about 111 points, or 1.5%. The NASDAQ Composite up about 2.1%. NASDAQ 100 up about 1.8%. And everyone else also getting in on the action. The S&P 400 mid-caps up 1.1%, Dow Transports up about 1%, the S&P equal weight up 1%, and the Russell 2000, Carol Massar, up 1.7%.
All right, good stuff. That's your big overview, folks. I'm going to go back to the big caps, the large caps, S&P 500, and you find most names in that index remain higher. 340 names gaining ground on this Monday, 163 to the downside.
Yeah, and sort of no surprise here when we look at the major indices here in the U.S., the major sectors, I should say, is communication services out in front, up about 4.3% on the day. Discretionary stocks, industrials, and tech stocks all getting bids. To the downside, though, energy, staples, and healthcare. Those are your laggards.
All right, so let's go to some of the individual gainers. Amazon, not too shabby. Now a $3 trillion market cap company. For the first time, crossing that threshold, becoming only the 5th company ever to reach the milestone. You can see the stock up about 4.6%. It has been on such a tear since it reported earnings last week. It's up 25% in the past 3 trading days. So we've seen investors certainly snapping up shares. It's joining NVIDIA, Alphabet, Microsoft, and Apple as the only companies that have reached this size. The average analyst price target calls for the stock to rise about another 14% over the year, where it currently trades, according to Bloomberg data. I should point out, too, AWS CEO Matt Garman joined our own Ed Ludlow on Bloomberg Tech earlier, and he said that the potential AI business for the company is just massive. So all in on AWS. Let's flip it on over to Boeing, also an outperformer in today's session. Tim pointing this out. Thank you very much, co-host.
The 737 MAX.
I know, up 8% in today's session. First of all, you had a couple things going on. Boeing received sign-off for the 737 MAX 7 from the FAA, ending a certification process upended by 2 fatal crashes and quality lapses. This review has been going on for about a decade or so. Boeing has about 282 unfilled orders for the MAX 7, so that opens up that gateway. The certification of the MAX 7 key to rounding out Boeing's 737 family and helping it generate cash and improve its balance sheet after several tumultuous years, to say the least. I should put out BNP Paribas also. Paribas, I'm trying to rush through, raised their recommendation on the firm.
French, Carol.
To
French.
Paribas?
Yeah, Paribas.
Did I say Paribas?
We took Spanish in high school.
Muy bien. No. BNP Paribas.
Well, you are from California.
You're right. I know that. Raised their recommendation on the firm to outperform from underperform. The analyst there sees risks for the firm abating over the next year. So that's certainly. And then I'm just going to throw one more in there. First Solar, top gainer in the S&P 500, biggest move intraday since October of 2025. First Solar up more than 10%. The Citi analyst Vikram Bagri raised the firm's price target on First Solar to 297 from 294 and keeps a buy rating. Jefferies, meantime, lowered their firm's price target on it to 196 from 207 and keeps a hold rating. The stock at 232 and change here.
All right, those are some gainers. I got some decliners. I want to start with one in the hospitality industry, Marriott International. The company said that room growth for 2026 would likely come in at the lower end of earlier guidance. Shares fell by 7% today. It's all about construction delays in the Middle East. It does expect net unit growth toward the bottom of its earlier forecast of 4.5% to 5%, the company said in a statement. And the conflict in the Middle East could continue to affect results, according to Jennifer Mason, the company's CFO. In the crypto world, shares of Circle Internet Group, also known as Circle, fell today by about 3.6%. We got a note from Morgan Stanley. They downgraded Circle to underweight from equal weight / its price target from $106 to $38. That implies a 39% decrease from last price. Morgan Stanley cited lower expectations for stablecoin circulation, a view that Circle's business model, too, will need to transition from reserve income toward transaction-based revenue. And finally, a couple of restaurants on our radar this afternoon. Sweetgreen shares fell 8.2%. Yum Brands down, let's go ahead and round that up to 3%. The CDC said that 2 deaths have been identified as part of the cyclospora outbreak affecting Michigan. We also got the Bloomberg News report this afternoon that said that Michigan health authorities were actually in touch with Taco Bell's parent company, Yum Brands, about a parasitic outbreak in early July. That was weeks before the company officially alerted consumers. Sweetgreen down 8.2%. Yum Brands, the parent of Taco Bell, down 2.9%.
All right, we are getting some earnings. This out of Palantir for the most recent quarter, its second quarter. It does look like a beat on the bottom line, 41 cents a share. The street was looking for 35 cents on average. Revenue above estimates at $1.94 billion in the quarter. The street was looking for about 1.81. Here's your forecast. We're going to start with the full year. The company says for the full year, expect revenue of $8.15 billion to $8.16 billion. So a tight range there. But more importantly, that's above where it had guided prior, 7.65 to 7.66. So basically going from about 7.66 billion in guidance to about $8.16 billion in guidance on the revenue side. As far as operating profit, the company also nudging its forecast up higher to $4.89 to $4.9 billion. On average, the street had been looking for about 4.5. So basically a beat and raise quarter for Palantir. Those shares up about 7% in the after-hours trade.
Yeah, a bit of a reversal. Maybe this is exactly what analysts were hoping for, because not analysts, excuse me, investors in the name, because the stock's down about 29% year to date. It is off about 40% since the stock hit a peak back in November. So some outperformance, certainly when it comes to that outlook in terms of fiscal year, is maybe why investors are saying, okay, here's a little bit of good news, 7.7%, Tim, to the upside.
I'm looking at the press release right now for some commentary from Alex Karp, and it's very much in his style of speaking. He says that demand for AI sovereignty has been unleashed. Palantir is the only company, according to Alex Karp, that has demonstrated it can transform tokens into actual economic value. He says our customers trust us to provide them with maximal control over their operations data and decisions. He mentions the Rule of 40 score. He says this quarter was otherworldly. Our U.S. commercial revenue grew. The Rule of 40 score climbed to 155%. The sovereign AI revolution makes us very optimistic about the future, he says.
And the Rule of 40, you add annual revenue growth and profit margin. The idea is that it should equal out to 40% or higher to make the company thing. And just a quick fact check, they're not the only company, but who've actually hit that on the token issue. But nevertheless, those shares up about 8% now in the after-hours trade. Meanwhile, slightly to the downside is On Semi, the chip maker, out with its results on the bottom line for the most recent quarter. 56 cents a share, up from 41 cents a share in the previous quarter. Adjusted EPS, that's a GAAP number, adjusted EPS at 74 cents a share. That is a slight beat. The street was looking for 71 cents a share. Revenue in the quarter we'll just call it almost in line with estimates, $1.6 billion. The street was looking for $1.5 billion. Here is $1.59 billion. Here is your forecast. The company says that for the current quarter, expect EPS of 81 cents to 93 cents a share. The street on average was looking for 84 cents. And it says expect revenue of 1.65 to 1.75 billion. The street on average was looking for $1.67 billion.
Yeah, and what's interesting is you're seeing the stock certainly rally in the aftermarket. It's up about 2.5%. It's been on a bit of a tear this year, up almost 50% year to date. 8% of that float is short. They've got a fair amount of exposure to the industrial space, automotive in particular, so we'll be looking for some commentary on that. But again, investors liking what they heard. This is the company's adjusted operating expenses forecast misses estimates for the third quarter. That's just a quick headline on some of our commentary on the Bloomberg. Again, on semi, up about 2% here in the aftermarket, and we'll continue to watch also Palantir. That one we've seen moving as well. I'm just going to bring it up real quick on my Bloomberg, and it is up 8.8%. All right, that's a wrap. Romaine, you can do this alone.
You got a slow Bloomberg there. We got to get you the pro subscription. Yeah.
What did you say about Romaine before?
He's saying I don't have as good. My tools are good. I'm just going to tell you. I'm sure it's fine. It's just, I got a lot of stuff on here on one little panel. I'm just going to say. Okay. All right. I hope you don't feel lonely over there. All right. That is a wrap. Our cross-platform. Romaine solo on the close on TV. Tim and I continuing on Bloomberg Business Week Daily right here on radio, folks. We will see you again. Same time, same place tomorrow. Maybe you can bring a friend, Romaine, tomorrow. All right. That's a wrap.
When we come back, a deeper dive into the tech trade with those earnings of Palantir and on Semi now on the wire. We're going to catch up with Lindsey Bell when we come back after the break, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romaine Bostick here, wrapping up the first trading day of the month of August, coming off a tumultuous July. And believe it or not, the S&P putting together 3 straight days of gains now. Remember, it closed out July with back-to-back gains. Today, it adds to that 1.5%, right at that 7,600 mark, and now well above all of its key moving averages. The NASDAQ 100 and NASDAQ Composite each adding about 2% in some of today's gains. Of course, aided by this drop that we saw in yields, and more importantly, by this drop that we saw in crude oil prices. In fact, of course, it has the opposite effect on some of the names in the crude and gas space, including Chevron, which was down about almost 2% here on the day. In fact, most of the complex in the oil and gas space taking a little bit of a leg lower. Meanwhile, you had a name like Boeing up about 8%. In fact, the best day for that stock in about a year. A big upgrade over at BNP Paribas, and finally certification of that new 737 MAX. As far as the tech space, well, look, we're finally starting to see some of these hyperscalers get their mojo back. CoreWeave up 19% on the day. Amazon up for a third straight day, up about 5%. In fact, Microsoft also up for a third straight day as well. Remember, you had seen a big sell-off in those names back in June and July, but some investors now feeling like they can re-embrace that story. And that is our top story. After one of the worst momentum sell-offs in history, is the pain over for some of these AI stocks? Well, Morgan Stanley strategist Mike Wilson seems to think so, citing a, quote, large player exiting most of its public equities portfolio as a typical endpoint for this kind of unwind. Presumably, that's an unspoken reference to the situational awareness hedge fund swoon of last week. Now, Wilson does make the point, though, that the next momentum cycle will likely look a bit different than the last, a rotation towards so-called quality shares with stable earnings history within that tech and AI space. You saw some of that play out last week with the diverging investor reactions to tech earnings. That greater discernment over the real deals in AI and the pretenders, it's become a hallmark of this earnings season, and, well, it continues this week. AMD and SpaceX, they're out tomorrow and today. In the here and now, we just heard from Palantir and on Semi. On Semi, not too shabby, but Palantir, a nice beat and raise quarter that I think a lot of investors were hoping they would finally get. Let's bring Lindsey Bell into the conversation, Chief Investment Strategist over at 248 Ventures. And Lindsey, that is where I want to start here. There was kind of a wholesale throwing out of the baby with the bathwater, it seemed, for a few weeks, as a lot of people said the AI trade had just gone too far too fast. We saw a reset of some of those valuations, and now as we continue to get the earnings, the E is there. The question is, does that P now start to get run back up?
Well, I think the problem is that earnings, it's likely that growth peaked in Q2 at 130%, I might add, for the semiconductors, and it should continue to be over 100% for the next 2 quarters. So we're not seeing any sort of massive deceleration for semiconductors. We're going to see great earnings. And it's nice, though, to see On Semiconductor come out and the stock react positively, because that really hasn't been the case across semiconductors, even though it has been a really good earnings season for the semis. And I think what we're starting to see now is, just like you said, we're starting to see a little bit of maybe a healthy rotation out of the semis back into the Mag 7, even though the semis got into correction territory. This upswing, double-digit upswing in the Mag 7 in the last couple of weeks really is starting to close the gap in the price performance between the two.
Well, that's what I thought was interesting, too, because it was like, like even today where we had this big rally, typically when you have these big broad market rallies, it's usually the Philadelphia Semiconductor Index that's well out in front of everybody. And you actually had it underperform the S&P, if you can believe it. I mean, forget the NASDAQ and the rest of those names. I mean, what does that say, though, about this idea of where people are looking at this tech trade? The idea that maybe it won't necessarily be led by the chips, and maybe it will be led by, if not the hyperscalers, maybe some of the other tech names?
Yeah, you know what? I think what we're seeing with this earnings quarter for the hyperscalers, for the Mag 7 in particular, is that we're finally starting to see that this experimental phase, as Microsoft called it in the AI space, is turning to a foundational technology layer. And that means it's actually turning into real revenue and margin growth. I mean, you look at Microsoft Azure crossing $100 billion in revenue for the first time. You look at Amazon's AWS margins expanding to 37%. And Alphabet, the Google Cloud, up 82% in revenue growth. And so these are really impressive numbers. I think finally investors are feeling more comfortable about their CapEx spend. And you even have players like Microsoft saying we're holding our CapEx spend where we're at now, showing some sort of discipline. But the demand is still there. So that should help support the semiconductors going forward. Again, we've come off more than 20%. I think the 200 moving day average is the momentum area that we're looking at in the semis to gain some traction. And I don't think that story is over. I just told you earnings growth is going to be over 100% in the next 2 quarters. There's definitely more room to run in those stocks. And this gets to the idea, I know onsemi isn't traditionally talked about in the AI space the way some of the other names are, though they've made a big push into that space. But they also have that bridge into sort of the analog and the sort of more industrial types as well. When you look at a chip maker and you're thinking, what you want to be associated with as an investor, is it just kind of the pure play AI name like an NVIDIA or somebody, or do you want maybe a chip maker that's a little bit more diversified? I think it's good to be diversified, and I think within the semi space, but also I think that's why these hyperscalers and the Mag 7 stocks are starting to show their real strength, because they are diversified. They have other parts of their businesses. I mean, even Amazon talked about their retail business and the strength there and the operating margin expansion that they're seeing there. So I think in general, being in the players that have diversified business lines is a good way to protect yourself from potentially any sort of softness that may come into the market. But I just think it's a great place to be diversified and find quality in general. I mean, it's interesting, too, because onsemi had been underperforming. Palantir, to a certain extent, had been underperforming. I did just want to draw your attention to another stock that has been a huge underperformer this year, and that's Snap. Their earnings just crossing the wire right now, and they're actually up about 12% here in the after-hours trade, beating on pretty much every key metric: revenue, EBITDA, daily active users, and they're also guiding slightly above what the street was looking for going forward. And I know you haven't had a chance to see these numbers, Lindsey, but I do just want to get your thoughts about this idea that some of these tech companies that had gotten left behind because they weren't maybe right dead center in the AI story, have we kind of forgotten them? I mean, we talk about Meta, which is just a huge ad juggernaut. Forget whatever Zuckerberg's trying to do with these data centers. But Snap, and the same thing. I know it's not a behemoth, but it is a reliable, steady generator of ad revenue, and I'm wondering if there is value to be found in some of those names. I think there is value to be found because these are companies that are putting up numbers that are not just mediocre. They are showing substantial growth on the top and the bottom line, and they've been forgotten about as everybody has chased the shiny new object, which has been the AI trade, and that semiconductors have been the main beneficiary of that for the vast majority of the year. And they ran so far that they got the dispersion between them and the rest of the tech trade it just got too crazy. And so now I think we're coming back to reality, and I think investors are seeing a sense of rotation into some of the names that have been forgotten, but remain high quality, have cash flow, are investing, and have future demand that is going to continue to drive and grow the operating profits and the stock going forward.
Lindsey, always a pleasure. Lindsey Bell, Chief Investment Strategist over at 248 Ventures. And speaking of the tech trade, well, we're going to get another big test tomorrow. SpaceX. They're set to report earnings, their first earnings report as a public company, and a lot of questions as to whether the hype can live up to a reality check. Julie Zhu over at MoffettNathanson. She joins us next, right here on The Close, right here on Bloomberg. SpaceX, it's set to report earnings results tomorrow. Its first report for Elon Musk since he took the company public. The share is trading well below the IPO price of $135, but that doesn't mean that expectations for this print aren't high. Julie Zhu joins us right now, research analyst over at MoffettNathanson. The firm has a neutral rating on the shares with a price target of 131. What exactly are the expectations here, Julie? Because I never know what to make of really any Elon Musk company. Are people going into this looking for an actual revenue and EPS number, or are they looking for whatever sort of a moonshot, pie in the sky, forecast that Elon Musk might give about where this company might actually go in the future?
First of all, thank you for having me, Romaine. That's a great question. I'd say off the bat, SpaceX IPO to great expectations, and it's not clear to us, and I would be remiss not to mention Nick Del Deo and Craig Moffett, my colleagues, co-cover SpaceX with me. And our point of view is that we're probably not going to hear all that much tomorrow to help us reset those expectations. And the way that we think about projections and forecasts versus the rest of consensus is that look, we're well below consensus on the AI and connectivity segments of the business for a number of reasons that we can talk about. And tomorrow, we're probably not going to hear anything that's going to either prove or disprove those forecasts.
We'll talk about the AI and connectivity. And just give me a sense here of how you value this company, Julie, in terms of is it a rocket launch company? Is it an AI company? Is it, Starlink? Is it all of the above?
SpaceX, in our view, sort of has almost a bit of an identity crisis. If you think about it, they have so many different parts of the business. And for us, the crown jewel is really the launch piece of the business. Without the bottleneck rocket capability, it's difficult to think of the connectivity business being available. The AI orbital data centers wouldn't even be a topic of discussions without it. And then when we think about valuing a business such as this, you have the piece that we call the known knowns and known unknowns, which are really the connectivity and the terrestrial AI piece that you can put numbers around. And then you have a component of the business that's likely going to come from the launch bottleneck for all sorts of space-related TAM expansionary activities that are difficult to put a finger on today, but are absolutely necessary to include in the valuation if you believe in this category of one launch position.
Give me a sense of what you expect with regards to CapEx spend and what I presume is going to be cash burn.
We continue to expect elevated levels. I think tomorrow what you're really going to see coming out of the numbers is you're probably going to see a beat in the AI business, and you're also going to see continued spend in that business. If you remember, SpaceX signed these terrestrial infrastructure as a service deals with Google, with Reflection AI, with Anthropic at significantly advantaged dollar per gigawatt pricing. And they're going to continue to invest behind that business as long as you see that there is a continued bottleneck and request for compute capacity. Now, based on my colleague Nick's research, this pricing is 2 to 3 times what you typically see is at a neo cloud, and there's going to be a question of sustainability going forward, but tomorrow you're probably going to see that be a positive or a good guy.
All right, Julie, great stuff. Really insightful. Got to get you back. Julie Zhu, research analyst over at MoffettNathanson. And for those folks that do care, there is consensus on the Bloomberg terminal. Revenue estimates, the expectation, $6.81 billion in the most recent quarter, with the AI segment posting an operating loss of about $2.39 billion and an overall loss per share estimate of 24 cents. We'll have full coverage of those earnings tomorrow, right here on The Close. Meanwhile, when we come back, well, we're going to get into the world of, well, stablecoins, crypto, and everything else. Shares of Circle finishing the day in the red after competing calls over the stock's direction. We're going to catch up with Dan Dolev with Mizuho in a second. Plus, we're going to take a larger look at the rails behind crypto with Yellow Card CEO Chris Maurice. A lot of activity around Circle. Morgan Stanley earlier cut its rating to underweight from equal weight / the price target all the way down to $38 from 106. Meanwhile, TD Cowen initiating with a buy rating and an $82 price target. And then you have Mizuho maintaining its underperform rating. Dan Dolev joins us right now from Mizuho, senior analyst there covering the fintech and payment space. Opinions about this company are all over the map here. But give me a sense here. I mean, you've been underweight for a while, and I sort of understand why. But do you not see any potential for upside anytime soon in this stock?
The only upside to the stock right now, thanks, always great to be on your show, by the way, Romain, but the only upside I see is if rates come up. Like, that's literally the only, and I actually think it might actually go the other way, but this is their only hope right now is rates go up, and the way they make money is P times Q, so they should hope for the P to go up. The Q is coming down.
Yeah, well, I mean, we should be remiss in not pointing out that, I mean, a lot of folks in the bond market think that rates are going up, particularly after, you know, what happened last week with the FOMC.
Yeah, and that could be the squeeze. That could be the squeeze. But fundamentally, it's an underweight because everything is going the other way, right? So Clarity Act is not happening. Bitcoin, which is highly
You don't
correlated,
think Clarity Act will happen? You think that's off the table?
We don't think this year it's off the table.
Really?
I mean, we're already in August right now, and you need like 60 days once it's going to, I mean, at some point it's going to happen, but it's not going to happen, you know, this year. That's at least what our experts are saying. Okay. Bitcoin is highly correlated. Bitcoin's not getting any better with them. And the biggest fear is OpenUSD, which is a consortium of 140, 145 different banks, financial institutions. They're all basically sitting there trying to, you know, disrupt or disintermediate USDC. Yeah. And those are the biggest financial institutions out there.
But how much of a commitment do you think they have to do that? I mean, I know that they've been talking about it, but I mean, is this something that's really going to come to fruition? Yeah. And do you think the cooperation will be there?
Yeah, because I mean, that, you look down the list, like everyone is there, right? Yeah. And it's too big of a prize because I'm bullish stable coins. I'm just not bullish USDC or Circle. So stable coins are there's real use cases for stable coins, and there's, you know, a lot of yield to be gained for that.
Yeah, it's been proven.
Correct.
Yeah,
it's just that they're giving it away to to their partners instead of retaining them, which is what Circle does. And that's it's a great business, but there's no model. There's no business model.
But this was when they first went public, this was what everyone was talking about. This idea was, could they be usurped effectively by the government, more or less, or something, some sort of quasi-government agency? And the general idea was that, given their size, given their footprint, that they would always have a role to some degree or another. You don't see that potential?
I think it's getting smaller and smaller because, you know, now with, for example, MasterCard being the dispatcher of stable coins, there's no advantage of scale. So they will have a role, but it's going to be raining stable coins. There's going to be like stable coins. I'm going to write a song about that.
It feels like it's going to hurt. Raining stable. I mean, are we there at that point? I mean, just broadly, this goes beyond just Circle, where we are actually going to see wider use of stable coins?
Yes, I mean we're there. It's already being used, you know, broadly and you know, globally. It's just that it doesn't matter. It's like you take your dollar out of your wallet, and I take my dollar out of my wallet. I'm a payments analyst, so I don't use any cash. But virtually, I take my dollar. It's the same dollar, so it doesn't matter. It's interchangeable and interoperable.
Well, I mean, you joke that you don't take a dollar out of your wallet. I mean, you know, I remember years ago, you know, the first thing you do when you get paid, you go to the bank ATM, take out cash so you can pay. I can't remember the last time I had a reason to even do that. I mean, everything we do now is in some way or another just done electronically.
There used to be lines outside ATMs.
You know, I mean, I'm sure in a few minutes my son will text me because he needs some money for something, and I'll just press a button and magically it goes there. So that future is here.
We're here.
Who controls that future?
the payment industry, right? Because the payment industry, Visa, MasterCard, the entire payment industry, which everyone hates right now for no good reason, it'll come back. The digitization of payments, the payments industry controls it. So it's anywhere from stablecoins to the networks, to the merchant acquirers. It's a great time to be in payments. To the lenders, it's a great time to be in payments. And people don't see that right now, but in 2-3 months, people are going to start seeing that again.
Who do you favor? Which company do you favor most in this space right now?
I still love Robinhood the most.
Oh, really?
I think Robinhood. It's not really payments. It's like online brokerages, but it's a singularity. It's the hyperscaler of next-gen brokerages. They're going to be global. This could be like a 10x over the next 10 years.
Yeah, interesting. Yeah, we had Vlad Tenev on last week, and it's kind of amazing just how diversified this company has been. Dan, always a pleasure.
My pleasure.
Dan Dolev, Managing Director and Senior Analyst over at Mizuho. And we want to stick with this conversation about stablecoins and talk about some of the infrastructure behind it. Our next guest, well, he does just that. Chris Maurice is the CEO of Yellow Card, which is a stablecoin payments provider operating across the emerging market space. Chris, great to have you here.
It's great to be here, man. Raining stablecoins sounds like the hit of the season.
I know. You were sitting here, you heard it, raining. I assume that's going to be good for your business if it rains to a certain extent, right?
It's, it's always raining.
It's always raining. I do want to talk about just the build out of your business, and I don't think we didn't mention it in there, but you just actually raised more money, another $40 million. Is that round? Is that correct?
Yes.
Yes.
Yeah.
Yes.
Yeah, we pulled together, a great strategic bridge here with, great companies. SC Ventures, Standard Chartered's venture arm, Sony's innovation fund, Polychain, Blockchain Capital, a number of great investors. All just, around this thesis that we've proven out in Africa and now have brought to the rest of the world, which is that everybody wants access to the dollar.
Well, that's what I'm curious about. I mean, we kind of said in the title, obviously, you started off with the focus on emerging markets, and we've told your story a lot about, your focus on Nigeria at the start. But then I was looking, so SG Ventures, Sony Innovation Fund, why are they in this?
Yeah, that's, again, it's just indicative of the fact that stablecoins are, really have gone global here. And so it's not, for us, it's not just Africa. It's how do you do the whole world, right? How do you bring this technology to the entire world? And so, specifically, what they're coming in to back us on is the USD global accounts, right? So named US bank accounts that we're able to issue to businesses anywhere in the world to be able to do instant stablecoin on and off ramping US dollar payments and domestic payments in 50 plus countries without SWIFT.
Yeah, okay, that's interesting. And SC made sense. I mean, that's Standard Charter. Obviously, a lot of their bread and butter is in emerging markets. And I assume they know kind of, or have some sense of where the puck is going with regards to the transactions and the use of stablecoins. I assume this is a bet on that longer term.
Yeah, those guys are deep in the space, right? They have, obviously they're working with us. They have, other plays that they're making in stablecoins. But, I think Standard Chartered has been, extremely visionary from a banking standpoint in terms of where this industry is going and where financial services as a whole is going with stablecoins and with this technology.
So where do you stand right now? I mean, as a business, you've raised a lot of money. I mean, are you like, I assume you've had, somebody's probably come to you and said, look, we would just buy you out. Have you gotten offers from any banks or credit card issuers, anything like that?
Well, look, people come. People come around, people poke. I think, there's so much more to do in this space, and there's so much more that, we need to continue building. That, look, if the right opportunity came around, we'd consider it. But I think, overall, we've been able to raise a lot of money. We've been able to, continue to push in this space. And we want to continue to bring this technology to the parts of the world that need it the most, right? Rather than just focus on the U.S.
When we talk about global USD accounts, I mean, like how big are we right now in this space, and how much bigger do you think it could get?
Oh, there's so much bigger that it can get, right? I mean, the TAM is essentially all of payments when you think of, stable coins and when you think of what this technology is doing.
And of course, everything is almost a whole world. But I mean, realistically, do you think it's going to become the dominant sort of source of cross-border, or not just cross-border, but even within border transactions?
Within borders is, a bit more complicated, right? I think when you look at international transactions, within 10 years, people will not be using other forms of moving money across borders, right? And even if you are using a company or anything like that to move that money across borders, they're going to be using stable coins on the back end. It's just such a paradigm shift in the way that money moves across borders.
But I mean, I've seen a lot of other companies, trying to do kind of what you do, Stripe, Wise, a few others here. I mean, what sets Yellow Card apart? I mean, what's the value proposition over your competitors?
Yeah, look, I mean, when it comes to, companies like Stripe and Wise, we're the ones building the infrastructure for those types of companies. I mean, so we're the ones that build infrastructure for companies to actually be able to move money internationally and on and off ramp all over the world directly against stablecoins.
Well, that's what you do for Circle. What is your relationship with Circle right now? I mean, you have the infrastructure for them, right? They're using your infrastructure?
So we use USDC, right? We use USDC and other stable coins for actually moving that money around the world. I mean, the big thing that we do that sets us apart, right, is there's a lot of companies that are using USDC and other stable coins to move money around the world, but then they only actually interact with the dollar. So you have a company that mints USDC, sends it to you, and then you got to burn it for the dollars. And all we did was add 2 extra steps to me just wiring you dollars. And so what we do is we go into countries all over the world, all over Africa, LATAM, Asia, et cetera, and we have direct liquidity and direct on and off ramps against the local currency. So instead of going, USDC to USD and then wiring that money somewhere, you can actually send the stablecoin directly to, China, right, to Africa, to anywhere, and then off ramp against the local currency.
I mean, we didn't bring this up. I mean, when we were talking with Dan Dolev earlier, I mean, Circle is trying to build out a payments network, at least based on what Bloomberg has reported. Does that become a competitor to you, a threat to you, if they are able to do that?
So we're part of Circle Payments Network, the
you
CPN
are
network.
Part of it.
Yes, yeah. So
and they're going to remain, in partner. You're going to remain in partnership with them, or they're going to remain in partnership with you?
Yes. Yeah. I mean, so look, unless they want to go, build this stuff out themselves across, all these countries, which, it's, a tall task, right? It takes a while. So we work with, great companies like Circle powering those types of payment networks, right? And Circle's just one of them. So we do this, across the board for, we work with great companies like Visa, Western Union, all these types of companies.
How much does, I guess, the prominence of the dollar and sort of the renewed focus by this particular administration on making sure that the dollar is sort of remains the central currency around the world, how much does that factor in to your business right now and any adjustments you would have to make?
Look, I mean, that has definitely been a big boost to the entire industry, right, and to stablecoins as a whole. And it has made the conversations that we have with, foreign banks, foreign governments so much easier around, why is this technology beneficial, right? And, the big thing that stablecoins are doing is they're extending dollar dominance, which is why, the current administration loves them so much, right? They're taking, the dollar, which, I mean, look, everybody loves to talk about the downfall of the dollar, right? But, they are extending dollar dominance by at least 30 years past, however much longer it already had. So it's really taken it to, another level, and it's going to keep the dollar, in its position as the dominant world currency for a while.
All right, Chris, great stuff. Great to have you back.
Great to be here, brother.
Chris Maurice there, CEO over at Yellow Card. Meanwhile, before we take a quick break, let's take a quick look at some of the after-hours trade. Beat and raised quarters for 3 big companies that just reported earnings. Palantir, onsemi, as well as Snap. We're awaiting those conference calls to kick off, but there was a lot of concern here about some of the sell-offs that we had seen in those names. A bit of a snapback here in the after-hours trade. We'll be back in a moment. This is Bloomberg. All right, keeping an eye on earnings, and well, keeping an eye on earnings tomorrow. That includes from McDonald's. The company is set to report as investors look beyond the chain for clues on broader restaurant demand and for any commentary, of course, around that recent outbreak of cyclospora tied to shredded lettuce. Joining us right now is Sara, Senatore. She's senior restaurants analyst over at Bank of America Securities. Sara, first, let's just start kind of with overall growth here. At least based on Bloomberg estimates, we're expecting comp sales to be up about 1.4% overall, U.S. comp sales, trailing international comp sales. Is that kind of in line with what you're looking for?
Yeah, I think what we've observed, and there's all kinds of high frequency data that we can look at. That's about where we are. We're between 0 and 1% for the U.S., a little higher than that for the international markets.
So when we start to talk about what the growth story is and what this company will articulate, where do you see that growth coming from? Is it just about more foot traffic into the stores, or higher ticket or higher receipts for the folks that are coming into it, or where?
Yeah, we hope, most restaurants would hope that it'll come from a mix of those two, right? So you want some traffic, you want either higher frequency or new guests coming in, but you also want a little bit of check, with some evidence that you can't take a lot of price, but maybe people are trading up or they're enjoying some of the premium items. McDonald's did launch the first wave, if you will, of its beverage initiative in May. There should be, we think, some attachment. So people who maybe would have gotten a soda now are getting a refresher. Then that helps with check too.
Well, talk to me about that specifically, because it seems like every restaurant chain is now trying to do these, whether they call them refreshers, energizers, whatever, Starbucks, Dunkin', probably quite a few others I'm forgetting. I assume that's got to be a relatively high margin product. Is there a sense here that they can push that further in order to boost the bottom line, or is it just kind of commensurate with you have to get a meal and then you get it, or are people actually coming in just for the drinks into a McDonald's?
Yeah, I think what McDonald's has seen, or what they articulated seeing in the test market in Colorado in particular, was that you did see some people come in for just a beverage in addition to attaching them. So, the idea behind these beverages was that they would bring in perhaps a newer, younger customer, but also a different day part. So maybe in the afternoon when somebody's looking for a pick-me-up or something, light as opposed to a full meal. And so I think, that's what investors will be looking for, signs that has held true even after it's launched more broadly.
One of the reasons why I ask, because it seems like in the past quarters there's been a big focus by investors on costs, and obviously McDonald's has a lot of exposure, whether it's beef prices, coffee prices, chicken, cheese, corn. I'm probably forgetting a few other things. Have we started to see maybe a little bit more of a moderation in some of those raw material price increases for McDonald's?
Yeah, so beef has really been the most inflationary part of the commodity complex for a restaurant. So anybody who sells beef is going to have some of that upward pressure. We've actually seen ground beef inflate more rapidly than some of the primal cuts, just as people perhaps trade down in the grocery store into some of the more affordable price points. So that remains a pressure point. You had asked earlier about the margins. Certainly what we see is that beverage margins are better than food. That is part of the appeal of that beverage launch to franchisees. The price points are meant to be attractive, very competitive, more consistent with McDonald's positioning. But yeah, as you said, there has been moderation across most commodities, just not beef.
Yeah, and I am curious just about the health of the consumer as well, Sara, because I remember on the last conference call that McDonald's held back in, I think, early May, Chris Kazemski was asked about kind of the health of the consumer, and he said that, that there was sort of, I guess, or he said he was expecting meaningful deceleration in the current quarter because of the run-up in gas prices. And I know gas prices have kind of fluctuated a lot because of whatever the heck's going on in the Middle East. But is there some sense that investors should anticipate that we might actually see some softness either in the numbers or in the forecast because of the potential strain on the consumer?
Yeah, I think part of the expectation, certainly, and I'll touch on the gas prices, part of the expectation was also just the comparisons get more difficult. I think the expectation was that the 2-year trends, if you try to control for the difficulties of comparisons, maybe looks better sequentially. So to your point, the 1 year for sure was expected to slow down. I think what we've heard, and we're early days in terms of the earnings season for restaurants, is that restaurants that offer something compelling are seeing traffic grow. So the low-income consumer is still under pressure. We have some signs that perhaps that's abating a little bit, or at the very least, wages perhaps are accelerating. So that's covering some of these elevated gas prices. But restaurants that have something, with respect to menu innovation or a marketing campaign or something that's unique have have been seeing traffic grow. And so I think, that's really what we're looking for, is those restaurants who can kind of cut through or break through the noise and really bring in customers across cohorts.
Well, that's what I was curious about, too, because I remember McDonald's kind of got dinged a lot, maybe unfairly, for how high its prices had gotten, at least for a full meals. And then they introduced the Big Arch, which was like a $10 burger, which for McDonald's was pretty pricey. I know in the context of Shake Shack and other things, it wasn't that bad. But I remember last quarter, they actually said that those sold pretty well. And I wonder if that was just simply because it was something new and in the minds of a lot of people, something novel and innovative that they wanted to be a part of. And people didn't mind spending a couple bucks more for that as opposed to a regular quarter pounder or a Big Mac.
Yeah, I think what we're seeing is the success of a barbell strategy, which is what the state of the art in restaurants, which is essentially you have to have some premium offers, whether it's because you need to appeal to a higher income cohort who is still spending, or because, again, the newness, and the value for the money is there. A big sandwich is a big price point, but it's a big sandwich. At the same time, you do also have to have some very accessible price points. So McDonald's relaunched value with their McValue 2.0. It has a lot of very low price points, $3 and under, in addition to some of these combo meal prices, that they pulse, whether it's a $5 breakfast meal or an $8 combo meal. And certainly at the local level, we're seeing some aggressive price points. But I think that's exactly right. They, among other restaurants, do need to have an array of offerings for all the different people out there.
All right, Sara, really appreciate you taking time for us. Sara, Senatore there, Senior Restaurants Analyst over at Bank of America Securities, as we set you up for those McDonald's earnings in the morning. And when we come back after the break, we're going to set you up for what to watch over the next 24 hours with some of the other potential market-moving events. That's coming up next here on Bloomberg. Let's set you up for what to watch over the next 24 hours, what the markets will have their eyes on, and it includes quite a few earnings. We were just talking about McDonald's, an interesting read on the consumer. We also get some interesting reports in the industrial space and in the healthcare space. Pfizer and Caterpillar also set to report before the bell tomorrow. Also look out for earnings from Apollo, Wayfair, and Merck after the bell. We're going to get a lot. Paramount, Skydance, Lucid, Pinterest, Booking Holdings, Amgen. And then two big ones in the tech space, AMD and SpaceX. SpaceX, its first earnings report since it went public back in June. On the economic front, we're going to get an update on our trade balance here in the U.S. We're going to get an update on factory orders. We're going to get an update on durable goods, and the drumbeat to Friday's monthly jobs report begins with those JOLTS numbers tomorrow. Also, on the politics front, keep an eye out for primary elections going to be held in Kansas, Michigan, Missouri, and Washington, a prelude to maybe what we might find out for the November 3rd general election. And staying in the political space, President Trump, we're told, is set to meet with AI firms tomorrow in Washington. We're going to try to get you some more details on that. I think the folks at Balance of Power might have some more information at the top of the hour.